Hello, everyone. Welcome to Awaken Your Freedom Show. Please subscribe to support our growing community. Today, we're going to be doing a deep dive into something called the Boglehead's Guide to Simple Wealth. Now, for a lot of you listening, especially those already kind of tuned into finance, you've seen it all, right? The gurus, the super complex strategies, the constant noise from financial news. It almost feels like building wealth is meant to be confusing, like it's some kind of insider's game. But what if?
Right.
What if the best ways are actually, well, simple? So simple they get overlooked. Our goal today is really to cut through all that noise. We want to explore this surprisingly powerful, but really accessible idea from the Bogleheads.
Yeah, and it's fascinating because the Bogleheads, the followers of John Bogle, the Vanguard guy, they didn't just make investing simpler. They sort of flipped the whole thing on its head. Their philosophy, it really takes apart that whole Wall Street mystique. It comes down to just a few almost counterintuitive things. Keep it simple, keep costs super low, and just stay the course. And the promise, which sounds kind of bold, is that if you really get this, you could actually end up wealthier than like 90% of other investors.
Wealthier than 90%, with something that sounds, well, straightforward. That almost sounds a bit too good to be true, doesn't it? Especially when we're always hearing about needing sophistication or active management.
Yeah.
What's the catch? Or what's the underlying reason this simplicity actually works better than all the complex stuff?
That's the million-dollar question, right?
Let's dig into that, starting with the first big idea. Costs matter more than you think. John Bogle had that great quote, "In investing, you get what you don't pay for." That twists your brain a little because everyone else says you have to pay for good advice or good performance. What's he really getting at there for our long-term money?
It's a really profound idea. Once it clicks, it changes how you see everything. What Bogle meant was every single dime you pay in fees, expense ratios, trading costs, advisory fees, whatever, it's gone. It's money that never gets a chance to grow for you. It's a guaranteed loss on your future wealth right from the start. And the long-term hit from even small fees, it's honestly staggering, much bigger than people think. Think about this. It's a classic example. Two friends, right? Both start with, say, $10,000. They invest for 40 years. Investor A picks a fund. Maybe it has a 1% annual fee. Seems small. Investor B goes for a low-cost index fund, maybe 0.05% fee. Tiny difference, you'd think. Fast forward 40 years, assuming the market does its average thing, Investor B doesn't just have a little more, they could easily have hundreds of thousands of dollars more.
Wow.
Hundreds of thousands, just from that fee difference. Not from picking better stocks, just lower costs.
Hundreds of thousands.
Yeah.
Just shaved off by fees. That really hits home.
Oh.
It makes me think of that analogy, fees being like termites.
Yeah, that's a good
But
word.
they're small, you don't really see them, they're quiet,
Yeah.
but leave them alone, and they'll just chew through the structure of your financial house over time,
Exactly.
relentlessly.
So for our listeners, maybe even people who feel pretty financially savvy, where might these hidden termites be lurking? Like in old 401ks or brokerage accounts they haven't looked at in a while? That's a great question because, yeah, the worst fees are the hidden ones. Beyond the expense ratio, which people might look at, there are trading costs inside funds, especially active ones that buy and sell a lot. Then you've got things like 12b1 fees, admin fees, sometimes load fees when you buy. So yeah, digging into your current accounts, especially older workplace plans, and just auditing for all those little costs, that can be huge. Understanding that even 0.5% or 1%, it adds up massively over 20, 30, 40 years. It's your money going to the industry, not your future, really highlights Bogle's point.
It's just incredible how that math works over time. Okay, so if job number one is slashing those costs, what do the Bogleheads say about actually picking investments? Because that leads right into principle number two. Don't try to outsmart the market. And let's be honest, that's tempting, isn't it? That urge to find the next big thing, that hot stock.
Oh, absolutely.
Or to perfectly time the market, sell high, buy low. We all kind of want to believe we can do it.
It's totally natural. That desire to win, the ego boost of being right. But the evidence, the data is just overwhelming. For almost everyone, even the pros, it's a losing proposition long term. There's this idea of market efficiency, right? Basically, all the known info gets baked into prices really fast. So by the time you hear about some amazing opportunity, chances are the price already reflects it. Trying to consistently find stocks that are wrongly priced is incredibly hard. Most professional managers, the active ones, they don't even beat the basic market index over time, especially after you account for their fees.
Right, you pay them more, and statistically you get less back than if you just plot the average.
Yeah.
That goes against so much of what we hear. So if beating the market is mostly a myth, what's the Boglehead way? How do you grow your money then?
It's beautifully simple, really. Just own the entire market.
The whole thing.
Pretty much. That's what low-cost diversified index funds, or ETFs, are designed for. Instead of betting on Apple or some small biotech firm, you buy a tiny piece of thousands of companies all at once. You're not trying to pick the winners, you're essentially capturing the overall growth of the economy, of capitalism itself. Look at Warren Buffett's famous bet. He bet $1 million that a simple S&P 500 index fund would beat a group of high-flying hedge funds over 10 years.
Right.
The index fund didn't just win, it absolutely crushed them. It wasn't even close.
Wow.
And that wasn't luck. It shows the power of just owning the market broadly and keeping costs down.
That's a really strong case. It shifts the whole idea from trying to be a clever trader to just being a long-term owner.
Yeah.
So if we're not trying to be smarter than everyone else, we just own the game board itself, what does that mean when things get rocky? Which they always do, eventually. That brings us to principle 3. Stay the course.
Exactly. Owning the board means you own the ups and the downs. And yeah, the market journey is definitely an emotional ride. Stocks soar, they crash, headlines scream disaster, politicians fight, your buddy brags about some crypto coin.
Oh, yeah.
All that stuff creates huge psychological pressure to do something.
I remember 2008, watching the news, that pit in your stomach.
Yeah.
It feels completely wrong to just sit there when it feels like the world is ending, you know? What is it about our brains that makes staying put so hard?
Yeah, you nailed it. Our wiring isn't really set up for investing calmly. We have loss aversion, losing hurts way more than winning feels good. So when prices drop, the instinct is sell, stop the pain. Then there's recency bias. We think whatever just happened is going to keep happening. Market's down, it's going to zero. Market's up, it'll never fall. Leads to panic or FOMO.
Buying high, selling low?
Exactly. And our herd mentality, we see everyone else panicking, so we panic too. Or everyone's rushing into something, so we jump in late. The winning move, the Boglehead way, is knowing these biases exist, feeling them, acknowledging them, and then deliberately choosing not to act on them. Just sit tight. Let compounding and the long-term upward drift of the market do their work. Think back to 2008 again. People who sold in the panic, they locked in those huge losses. People who held on or even kept buying, they saw their money come back and then double, triple, or more in the following years.
It's like that saying about planting a tree, isn't it? You don't keep digging it up to see if the roots are growing.
Perfect analogy.
You plant it, water it, give it time. But man, resisting that urge to tinker,
Yeah.
especially when, like you said, recency bias kicks in and we let the last few weeks dictate our 30-year plan. That's the real fight.
That's the discipline.
It does sound like sticking to this reduces a ton of stress, though. Less guessing, less regret.
Oh, absolutely. It frees up so much mental energy. You stop trying to predict the unpredictable. You trust the process, trust the long-term picture. And that mental calm is crucial for the next step, our 4th principle. Asset allocation is your superpower. Now, just to be clear, especially for listeners who know the basics, Bogleheads aren't saying throw everything into stocks and ignore it. That's not it. The real finesse, and maybe where even experienced folks can fine-tune, is in how you allocate your assets. Thoughtfully.
Okay, so it's simple, but not that simple. It's not just buy an index fund and walk away forever.
Yeah.
Where does the allocation part fit in, and what's the common trap people fall into with their mix?
Right. It's a critical layer. Asset allocation is about building a portfolio that fits you and lets you sleep at night. It's deciding the mix. How much in stocks, that's your growth engine, right, for building wealth over the long haul. And how much in bonds, that's your stability, your shock absorber. They tend to zig when stocks zag, smoothing out the ride. The common mistake. Often it's being either way too aggressive for your actual stomach for risk.
So you end up panicking and selling stocks low anyway.
Exactly. Or sometimes being too conservative too early and missing out on growth you needed. Finding that balance based on your age, your true risk tolerance, like how you'd really feel if your portfolio dropped 30%, and your goals, that's the key. It helps you stay in the game during those downturns because not everything is plummeting at once. A common starting point people talk about is the own your age in bonds rule. So if you're 40, maybe aim for around 40% bonds, 60% stocks.
Just a guideline, though.
Totally, just a guideline, a starting point. You have to adjust it for how you feel, what makes you comfortable enough to stick with the plan. And maybe consider things like the current interest rate environment, too. It's personal.
That makes sense. Personal comfort helps you stay disciplined. It's kind of like salt and sugar in cooking.
How so?
Well, you need both for a balanced dish,
What?
right? Too much salt, it's inedible. Too much sugar, same thing. But the right mix makes something sustainable, something you actually enjoy long term.
Huh. I like that. A perfectly balanced dish. Exactly. And getting that balance right lets us really appreciate the fifth principle, which is maybe the deepest one. Investing is about life, not just money. It's so easy to get lost in the numbers, the performance charts, trying to beat some benchmark.
Yeah, totally. Obsessing over the spreadsheet
Yeah.
and forgetting why you're even doing it. So what is the bigger why, according to this philosophy? What's the point of building wealth, if not just to have more?
That's the core reminder. Wealth is a tool. It's not the end goal itself. It's not about having more than the next person or winning some imaginary game. It's about buying freedom. Freedom to choose how you spend your time. Freedom from money worries. Ultimately, it's about peace of mind. It's about funding the life you actually want to live, whatever that looks like for you. And the actions Bogleheads recommend support that. Save consistently. Invest automatically, set it and forget it, basically into those low-cost, diversified funds. And then, this is key, stop checking it all the time. Go live your life. John Bogle himself said it perfectly. The greatest gift of investing is not wealth, but peace.
That's a really powerful thought. The greatest gift is peace. It implies that if your whole money strategy is making you anxious and stressed out, maybe you're overcomplicating it,
Exactly. Simplicity equals sanity.
especially with money.
For sure. The aim is a financial engine that supports your life, not one that becomes the main source of stress in your life. And to make this really concrete, think about some real stories. We hear them often, like that classic comparison, the quiet school teacher and the high-flying banker. The teacher, making a modest salary, just diligently puts away a bit every month into index funds, sticks to her allocation, never tries to time anything, the banker. Makes a ton of money, but is always chasing the next hot tip, paying huge fees for expert managers, jumping in and out based on headlines. After 30 years, who do you think actually ended up with more?
I'm going to guess the teacher. It's that whole discipline beats ego thing again, right?
Yeah.
It's not just what you earn, it's what you keep and how you grow it.
You got it. The teacher often ends up with significantly more. It wasn't about being smarter or starting with more money. It was just consistency, simplicity, patience, immense patience. And these aren't just fables. The Boglehead community, you look online, it's full of stories like this. Ordinary millionaires, janitors, nurses, regular folks who built serious wealth just by living below their means and investing simply, consistently for decades. It really proves this isn't some strategy only for the rich. It's a path anyone can follow if they have the discipline.
Wow, that's incredibly motivating. So wrapping this all up, the Boglehead's Guide, it really feels like a calm voice in a hurricane of financial noise, an antidote to the hype, the fear, the complexity. It's asking for discipline, maybe, more than genius.
That sums it up nicely. It really is. The core truths are pretty simple. Tune out Wall Street's noise and its complicated products. Put your savings on autopilot. Buy the whole market super cheap with index funds. Keep those fees almost non-existent because they're wealth killers. And then just sit tight for decades. Resist that urge to fiddle when things get scary or boring. Do that. You'll almost certainly build wealth. Not tomorrow, it takes time, and there will be bumps. But steadily, surely, and without all the usual stress.
That's a really empowering message, especially for our audience looking for that clarity. So for everyone listening right now, here's a challenge, a concrete action step. Pick just one of these Boglehead moves and actually start it, like today or this week. Maybe you finally open that low-cost index fund account, a Roth IRA maybe, or just a regular brokerage. Or maybe you go into your existing accounts and set up automatic monthly contributions. Make savings effortless. Or, if you're already investing, take an hour this week. Really dig into your statements, hunt down those fees, and slash anything unnecessary. The sooner you start applying these ideas, the sooner your money starts working quietly, steadily, relentlessly to build the life you're dreaming of. To close, please don't forget to subscribe on your favorite platform, YouTube, Apple Podcasts, Amazon Music, or Spotify to stay sharp and never miss a drop of knowledge that could change your financial life. Thank you.